Good morning, everybody. Thank you for watching Taxes Made Easy. And we have some interesting topics to cover today. And main thing we're going to focus on is for small businesses, what your requirements are for filing and how to get ahead of this and not have to worry about the IRS. So how to crush it and making sure that you are hitting all your filing requirements and stay on top of things, not only financially, but avoiding any problems with the IRS. So we'll be right back shortly to address these topics. Welcome back, everybody. Thank you for watching Taxes Made Easy. We're going to start off talking about some news coming out of the housing market, which is a little hard to understand what's going on lately because it's been good news, mostly bad news, but then it, it it kind of really has been going back and forth. So
Come into your local Safeway for deals on all your seasonal faves. Grab must-haves for easy weeknight meals. These offers change each week, so don't miss out. Come see what's fresh at your local
I
Safeway.
think this is absolutely true.
So my next guest
But
is
value,
affordability crisis as well.
it's based on supply and demand.
and he launched
prices
Resi
would go
Co-op.
down if we
Joining me
didn't
now,
have the
the
demand.
co-founder and
We
editor-in-chief,
didn't have so many more
Lance
people
Lambert.
needing housing in our
First,
country.
let's just start about your mission. What is the mission
And
of
if we
Resi
didn't
Co-op?
have,
Yeah,
high
my mission
inflation
is to
going
track
on,
the U.S. housing sector
but
and
part of
really
it
be
is
folks'
prices were
gateway
going up
to the U.S. housing market. And
before
we're such at a critical
COVID.
period for the U.S.
Prices were
housing market with
really starting to
affordability
go
getting
up
so strained
because
that I really just want to shed a
haven't
light on
built
what's
houses.
going on.
We haven't
So
focused
to
on
that
it.
point, it is
There's
not
been
only
a
is
lot
it
of
getting
red tape
strained,
in the
but
way.
I
So
think
the
it's fast
more
becoming a
barriers you
political hot
build,
potato.
you put in the
We
way,
have President Biden kind of
the more it
wagging
dries
his
up
finger at
housing,
these
and
greedy
the people that
agents.
own
Just
homes
the other
think it's
day,
wonderful. It's great. They're seeing
obviously
equity
other
go
kinds of
up.
moves are happening nationally. And I read a
But
note
it
where you
really
say these kind
does
of things are mostly scapegoating.
really does hurt. And so right here in the
So
video in the
taking-
background, I wasn't going to share the video. I'm not going to share the video, but priced out starter homes are unaffordable for many Americans. So for the next generation, that's the difficult part, is that they don't have the funds to pay, coming out of college, to pay for $400,000 to $500,000 home. That's $500,000. Wages have not kept up with that. So there's plenty of states trying to force wages to keep up with that, but it really is making it harder and harder by state. So this talks about some of the states that have been hardest hit, but overall, sorry, real quick before we go into that, 11.1 increase year over year, or by the end of 2023, 11.1 increase in the values of homes. And 2024 has seen that price kind of stagnate. But it's kind of stagnated at that high level because interest rates have gone up. And so this is about 90%. Most U.S. metro areas have seen it go up considerably. And it's the South being hit the hardest. Why the South? Because people are flocking to areas where they can work remotely, which is a new trend. But again, that areas housing is still relatively affordable, but you can see how that's changing very quickly. So Tennessee, almost 450,000 median listing price. Arkansas, again, don't have the wages or the jobs to support this, but a lot of people are coming in. South Carolina, 350,000. Montana, 650,000. Now Montana is beautiful, but good luck. If that's your average home and you're coming out of college, how do you afford to live there? You can't. And that's the problem, is that people have to live to places where houses are more affordable, or buy a tiny house, something like that. Alabama, 330,000. It talks about years of underbuilding, fueling the shortage of homes. One thing that it doesn't mention is immigration. You put so many millions of more people into the market, rightly or wrongly, but it's just a fact of life. You have more people needing housing, and that affects all everybody else. So when I years ago, when I was still in California, before the prices went up like crazy, there was a huge rental issue going on in Sacramento, and it's because it brought in a lot of refugees. Not necessarily a bad thing, we want to help out, but these were war-torn areas, and a lot of refugees were resettled in the Sacramento area. And what happened is that they took over a lot of the most affordable rentals, which drove up the rents for everybody else, and were forcing people, it was a huge problem because plenty of people were being forced into rents that they couldn't afford. They had to cut down. It was really brutal. And this is a real thing that happens when there's always consequences. When we do something nice, there's always somebody getting hurt in the process, unless we prepare for it. And that's the problem. Government never prepares. They just do things and hope that the consequences don't come to light. So again, home supply is down 34% compared to prior to COVID, and that's pretty typical. That's what I'm hearing from realtors. And then you have the golden handcuff where people don't want to leave their home. Why would you when you have a 3% inflation rate? So, and again, mortgage rates are looking to stay elevated in 2024. They're only going to fall when the Fed starts cutting rates. And so far this year, they're not expecting them to be able to cut rates. The rate is down a little bit to 7.2%, where it was at 7.79 is the peak of the interest rates. But how do you get by? How do you still afford a home with all this craziness? So here's more stats about people willing to sell their home. That they're nearly twice as willing to sell their home if their mortgage is 5% or higher, but these are almost usually new home buyers, or relatively new. However, 80% of mortgage holders have a rate below 5%. So if you're at 5%, let's pay in cash for a house. Why would you move? It doesn't make sense. So jumping to the next article. This is about the interest rate dropping, hold near 7%. That's good news, but again, still high overall. How are they beating the borrowing costs? Bigger down payments. So people have to save up, which is hard to do when you're renting. But save up, try to get a 15-year mortgage. Whatever you can do to save on the costs here. And that's really what they're trying to focus on. Is they've decreased for the second conservative week. Watch for this. It might be the time to go out and buy. And then making a large down payment can really reduce how much you're going to pay in the long term and also help your interest rate. And so they have government's passing more initiatives to try to get more housing out there. But that's not really what I want to focus on, because we've talked about all that before. A new $10,000 tax credit being proposed, hasn't passed yet. So we'd love to see more people, homeownership go up. It is expensive, and ironically, the IRS will not allow for the actual price of homes across the country. Their allowable numbers are grossly distorted and getting worse each year as they twist and manipulate inflation numbers. But I'm not going to go down that rabbit hole right now. As you can tell, it's a sore subject for me. So want to talk about some tax policy here. And there's a lot of news coming out still about Trump versus Biden's tax plans. And here's an interesting one. I'm going to argue one side of it, or present information about one side of it, and then go the other way. Try to be fair and balanced. Here's labor unions call for the repeal of the Trump tax cuts. So I think there's a lot of, it's almost like there's a concerted effort to, kind of portray the Trump tax cuts as bad for the country, bad for individuals. And I saw one article, again, it was, one that you had to subscribe for, and it wasn't a normal newspaper, but it was trying to argue that the Trump tax cuts, by repealing those, would help people, that your taxes would go down if those were repealed. I'm like, well, the actual numbers for everybody would go up. So how would your taxes go down if you got rid of the Trump? So it's some creative thinking there, but it doesn't make a lot of sense. It would go down for some brackets. No, I think it would go up for everybody. The individual deduction would be cut in half. So again, it would help pretty much anybody that's paying taxes. So the UAW, the SCIU, SAG, Screen Actors Guild, and other NEA, National Education Association, are joined with dozens of other progressive groups in calling for blasting the Trump cuts as unfairly designed and fiscally irresponsible. So I think this is the key here, is they're claiming that it's fiscally irresponsible to cut or have tax cuts in place when our spending is, or no, when our deficit, yearly deficit, is out of control. It's like, well, if we didn't have these tax cuts in place, we would be collecting a lot more money. I don't agree with that. When Trump put his tax cuts into place, the revenues didn't go down, they went up. And people question this, and this is where it's short-sighted thinking here. Why would tax revenues go down? I mean, still go up when you cut the taxes? Because then people bring money back into the country, they invest in the country, and the economy booms. That's what typically happens when you do tax cuts. That helps the economy. And right now, our revenues are higher than ever. So they want a more progressive tax code that keeps tax cuts in place for the poor, for the poor Americans, but sucks the higher income and higher wealth households, corporations, and Wall Street. The funny thing is, when you're attacking corporations, who are you really attacking? Pensions. You're attacking 401ks. Anybody that has money invested in the market. Problem is, more and more people can't afford to invest in the market. But instead of making it easier for people to invest in the market, they're going the opposite direction. So it's interesting here that they're really pushing hard for this. Sorry, I got these other things popping up. And it decreased the corporate rate from 31 down to 21%. And they're arguing, well, they didn't result in the higher wages. That's higher profits directly in the pockets of Americans that invest in the economy. So you have two competing thoughts here. And I'm out of time, so I'm going to have to pause for a second and deal with this one, cover this when we come back. Welcome back to Taxes Made Easy. We were just about to dive into an important part of economics, and this is something I haven't really talked about on the show. And so there are two ways to drive an economy. First of all, consumer spending, which is what most of our economy is based on, is consumer spending. And if you have the economy is based on people constantly buying stuff and using up things. So, food, stuff we have, items, phones that aren't built to last, computers aren't built to last anymore. It really drives me nuts that if you're active, I mean, you have some computers, if you only use them for basic things, you can have them for quite a while, but most of the stuff in our economy is not built to last. So when you're buying stuff, you're consuming or using these products over time, and you have to go and you have to keep buying things over and over again. Now, that's one way to run an economy. A better way to run an economy is to have an economy built on savings, because the less savings you have in an economy, the less investment. So people have to borrow from outside to bring investment in. And so by saving and having funds in banks, so that can be lended out and create money flow throughout this system, people can be more productive, people get more rewards, and it's a great way to enrich the poor in America. It gives them a way to be socially or economically mobile upwards, which is what we should want. Too often we want to punish the rich, attack the rich, and instead of helping other people become richer. People that are struggling, we don't help them and make it easier for them to create wealth. But that's what we should be trying to enable for everybody, all Americans, is make it easier for people to achieve the American dream, get a house, get a good job, invest for their future. And again, people are going to make poor decisions. That's just the way it is. But giving people that opportunity is key, and I think that's what we should be focusing on in our economy. So on that note, I've got another article here. And so this is an interesting article. This is from Mass Live, but in multiple articles talking about it. Crushing it. The Massachusetts legislator is so thrilled with this millionaire tax revenue that they passed. And are they getting money for it? Absolutely. So they've collected about $1.8 billion from this new tax on the state's millionaires. So 4% income surtax, which is an extra tax that just targets millionaires. That's just in the first 9 months of the year. Doesn't that sound great? So, the Democrat-led, it's Massachusetts is run by Democrats. The Republicans are pretty much, it's a sideshow. So, the point of this is that this is, so here's one proposal that they want to do is have a university community college is universal community college, which means everybody can go and attend community college, which isn't a bad thing. But again, the focus is on when you just hit the rich, are there going to be consequences? Is this going to hurt the state in the long term, but also hurt the people of Massachusetts? So this new law, this new tax, is supposed to be earmarked just for education and transportation related items. Now, having grown up in California, every time there's a new tax, they make the new tax, supposed to go for education and transportation or whatever their purpose is. What the state is really good at doing is that they'll cut other sources of funding. Say, oh, okay, well, now that they have this, we can use this money elsewhere. So unfortunately, too often, it doesn't lead to a net positive gain in funding for these sources, or again, they play funny games with the budgets all the time. So, and they said they don't have any problem. There's two areas of immense need, which means they haven't been spending or making for capital investments into education and transport. So that's to improve, educate, actually build things for education and fix the roads. So they're saying for almost a year, it's making a real difference in people's lives in Massachusetts. The problem is when you pass taxes like this, it's not, there's always a consequence for it. And so they're brushing aside the critics of the levy, saying that they would flee Massachusetts rather than pay the tax. He's saying, look, we're getting billions of dollars. But, however, who's leaving and has been leaving the base state of Massachusetts between 2020? And they just passed this law. But Boston has lost 25,000, making it one of the biggest losers of metropolitan areas during that period. So the question is, long term, what's going to happen here when you increase taxes on the rich and add a surtax? It's going to affect things. And so one of the concern here and is and this is a little bit harsh, but this is coming from Blaze Media, really addresses this issue of capital flight. When you tax and you tax the rich, what really happens? So if you don't know Galt's Gulch or Atlas Shrugged, this is a book that I read in high school. I was assigned to read it. I didn't read it. It was for an essay. The essay came and went, or the deadline for the essay came and went, and then I had the book, and I was like, I'll look at it. And I started reading it. And, it made a lot of sense. And it's kind of an extreme example in Atlas Shrugged. So a quick summary of the book. Basically, you have the people that are producing in society, and then you have the political class, people that aren't producing, and the masses constantly claiming greater and greater claim to their what they create, their fruits of their labor, and going after the super rich to provide for everybody else that aren't producing, that aren't innovating, that aren't the great producers in society. Now, I don't agree 100% with what Ayn Rand's premise was, but the idea that the more you attack people that are the producers in society, they'll go elsewhere. They may choose to withdraw their talents altogether, which is the point that these producers, instead of working on huge global things, they just want to be involved, they want to be create. And so a society, a secluded community was created where they would go and do their thing without interference from the outside world. And they were happier rather than fighting the government. So here we talk about increasing capital gains. We talked about Trump reduced it to 21%. Now they're talking about increasing it not only to 35%, but to 44.6%. So again, investors, this is going to really chill investing, really going to hurt small business owners, and people really looking at the numbers. How's it going to hurt the economy? So when you look at it, first, the individual tax rate is 37% currently. They want to increase it to 39.6. Doesn't sound like a big increase, but they're increasing an additional tax on there from 3.8 to 5%. So for your average person, you look at the tax rate, it's like, okay, that's what I'm going to pay. But when you pile on everything else and all the other taxes on it, there's plenty of ways where you have double taxation. And so long-term capital gains, qualified dividends will be taxed at ordinary income rates. And this is above $1 million. But this raises the top federal tax rate to 44.6%. When you add in state taxes like California and New York, you're looking at about 60% tax rate. So when you're taxing something at 60%, do you think you're going to get more or less of it? A lot less of it. I mean, when that's close to Carter level tax rates of around 70%. Coming out of World War II, the tax rate was up to 90%. But you had a justification. We were fighting a world war. We needed the money. We're not fighting a world war. And to have tax rates up to 60% is just, many people argue and are arguing that this is just fiscal theft. So again, it goes into the couple spends decades building a small business. Then they decide to settle their life's work as they retire. And it's not just hitting the ultra rich. Yesterday I spoke about someone that had 2 homes that they were going to sell. They're going to pay hundreds of thousands of taxes on that, even though that's really their retirement nest egg. But something's happened. They need their money. They need to sell, and they're going to get hit hard in taxes. And just average couple have planned and prepared for their retirement, but this is going to hurt their retirement quite a bit. So they're saying, look, we have to expand the size and scope of federal government. There's always so many ways. There's so many ways that the federal government expands and increases it. Every time you give them a new tax dollar, they spend 2. That's just the way it is. They need to fund the Green New Deal. Medicare is not being funded correctly. But instead of fixing these issues, they leave all these huge time bombs. And then they just go spend more. So our revenue has increased every single year. But the problem is it's always been outpaced by our spending. So again, revenue is near historical averages as a percent of GDP, but spending remains above historical averages and is projected to go to record high unsustainable levels. Mainly as interest goes up, it's going to really, really hit that hard. The problem is, as a society, we're not. When you tax one, you attack part of American society, you really are attacking all of it. And it's this us versus them mentality only hurts all of us. So that's why I really support helping people invest and take advantage of the same things that the wealthy do. I think the advent of mutual funds and many different ways to invest has really been a huge help to the middle class, to people that want to build wealth over time. The problem is we're making that harder and harder today with taxes and the cost of living going through the roof. So I've mentioned before how Brazil wanted to do a global tax on billionaires. Now, most of the billionaires are coming out of the United States. So really, in essence, this is taxing a lot of the wealth coming out of the United States, because economically we're still one of the most free countries in the world, even though that is going down. So Brazil, France, and Germany want the world's billionaires to pay a global wealth tax. Why is the U.S. against it? Because most of the billionaires are from the U.S. And Janet Yellen, who is, again, very progressive, very much leans left, but she's even come out against this idea, saying, look, this is not the way to go when it's going to disproportionately impact the United States. This is wealth redistribution from the United States to other countries, forced wealth distribution, and it's going to drive billionaires and productive people even further away from the United States. So again, this goes into this, and they really want to do a global 2% of the wealth, not of their income, but of total wealth of the ultra wealthy. And I mean, would this be every single year that they'd be taking 2%? But again, it would not apply to billionaires who already commit a fair share in income taxes. So in other words, it would target those that have lower tax rates. It would target countries that do try to attract capital, whereas billionaires already paying a high percentage in more socialist countries would not be even affected by this. So even more designed to attack in the United States. Anyway, it's interesting that you get these opinions from both sides, from the left and the right. But you have plenty of people, that lean left, whatever, raising alarms about this, raising alarms saying, we can't do this to our economy. We can't do this to our future. And where does that future come out? It's for our children. It's for the people that are trying now to start and create businesses, because that's really one of the biggest drivers of growth. It is the biggest driver of growth, is small businesses. So that's what I really want to focus on. And this is from, I mentioned this article yesterday, just looking at it. I think this is very key for small businesses to know and understand what they need to do, how to grow in this crazy economy, and prepare. Use tax planning to your advantage, because as the taxes go up, as things get crazier, you need to plan. So the biggest thing here is make sure you have your record keeping in place. I yesterday talked to a client, or a potential client, and I told them, don't hire us. There's nothing we can do for you. She wanted to know if she should go to tax court. And she had gotten audited. She had legitimate business expenses. But in the audit, initially the IRS claimed that she owed that she had $113,000 or something like that in unreported income. Now they appealed the first audit, and then they said, okay, we'll go down to $56,000. They said the tax on that will be about $20,000. Yeah, it's about right. And the problem is they had a choice: either go to tax court and try to fight it, or just accept it and pay the $20,000 over time. And they can get on an installment agreement for that. But they were saying, well, can we fight this? Because these are legitimate business expenses. I'm like, well, what about your record keeping? She said, she said the IRS even told her that a judge is not going to accept all of her expenses because, number one thing, they did not have a separate business account. So they were mixing their personal and business expenses together. So even though they're legitimate business expenses, because they do not have good record keeping, they get to pay an extra $20,000 to the IRS. And the IRS knows it. It's just she can't prove it up very well. And they're going to scrutinize everything when you have personal and business expenses mixed. So I told her, first thing, go open a business account today. Your CPA, your bookkeeper will love you for doing this. Should have been done. She's like, okay, I know. And they've told me. I'm like, yeah, you have to do this. But I said, it doesn't make sense to hire an attorney and go to tax court, because they're going to charge you $20,000 to $25,000 if that's how much you owe. It doesn't make sense. Bite the bullet. I would take what they're offering you. But again, this is a classic example of why you need to have good record keeping. So we're going to dive into this more when we come back. Welcome back, everybody. So this is something that's near and dear to me. Helping people do things the right way and avoid all kinds of issues. So, like yesterday, it was something that came, and their main question was, should we go to tax court? Does it make sense? I told them, look, sorry, don't hire us, don't pay us money. It doesn't make sense. And I gave them some free advice and sent them on their way. But again, they could have saved $20,000 for their business easily just by having good record keeping. So altogether, there's 57 million small businesses and self-employed taxpayers in the U.S. Again, biggest driver of job growth is small businesses. These are all have assets less than $10 million. So if you sole proprietors, independent contractors, partnerships, so anybody running a business, not working for someone else, even if it's a part-time business. Gig workers, so Uber, Lyft drivers, owners of Airbnb, rentals, delivery services. So there's a lot of good information here in Taxpayer Advocate. It is supposed to be a neutral voice at the IRS where you can get assistance from them. They do have good information on their website. And when we have really nasty cases with the IRS, so the IRS is just being stupid, and I mean that in all sincerity, we go to Taxpayer Advocate to try to get our case taken care of. It's not a silver bullet. It takes them a long time to get assigned to a case, but they can definitely help with some sticky cases. So if you're not familiar with what kinds of taxes you need to file, and for most people, if you're open a small business, talk at least to a tax preparer. Make sure you get registered with the state. And if you are selling anything, please, please, please get set up with the state where you're paying your excise taxes or your sales taxes. So if you're a sole proprietor, it just gets reported on your 1040. You have estimated taxes that need to be paid, and if you have employees, it gets even more fun. So 940, 941, or 44 or 43. Partnership, Form 1065, and I can't tell you how many times partnerships have not been run correctly. They have not been done correctly. It causes all kinds of problems. I've seen people switch between partnerships and filing as if they're a corporation. It just becomes a giant mess. So elect how you're going to plan out how you're going to create your business, get a good idea, I have corporate attorneys I can refer you to discuss what would be best, and they're not going to charge an arm and a leg just to get some information. Now, there's many different types of, you could have a partnership. This is an individual. You can have a corporation. So C corporation, most small businesses are either an S corporation. Elect to file as an S corp, and then you have estimated tax payments, employment taxes, and then S corporation shareholders. So record keeping is key. If you're doing a lot of things wrong, if you have your record keeping done right, it is absolutely key. So, true story, I had someone came in and hired us, and they wanted us to do everything, to manage the tax preparation. We told them, okay, well, here's what needs to be done first is we have to go in and do the bookkeeping. We have to go back, put it all together. They said it was mostly together, just need to be reviewed. We sent it to our bookkeepers. Well, to one of the firms that we recommend. They came back and said, hey, this is a huge, our quote for this is going to be around $15,000 because it goes back years. They have multiple locations, I believe it was restaurants, and they had workers that the payment histories hadn't been managed correctly. And they said, look, it's going to be around $15,000. We didn't even charge them that much. And so we actually gave them a full refund and say, hey, we can't do this for this price. and they weren't happy. But I said, look, your books are so bad. This is what it's going to cost. And we called around and got a couple other quotes. They were in the same range. So how do you, first of all, there's a shoebox method where you take all your grocery receipts, all your inventory, and you just shove it in a shoebox. If that works for you and you can save your receipts like that, great. That's one way to start. But the best way to track your expenses, and pretty much anybody doing any kind of small business, you need to have your own business bank account. For many reasons. It helps you understand how much you're actually making for the business, whether or not you're losing money. A lot of people spend good money after bad money. And if a business is really, truly failing, it can either become a hobby where you don't get any expenses written off, or you should close it down. Most small businesses do not survive, but they can support you for a while. But when it starts costing you money to run it, you should have that information to make that decision. And this is just kind of an overview of some of the things you need to do. So we talked about the shoebox method. If you have everything running through your bank accounts, that's a great way to do it. And if you use a credit card and you just pay it off every month, that's fine. But if you have a business credit card, just use that for business expenses. Don't use it for anything else. So no personal taxes, I'm just going to throw a lunch on here or whatever. Don't do that. It creates lots of problems. And if they see personal expenses flowing through business accounts, you can lose out on a lot of legitimate business expenses. They'll go through with a fine-tooth comb and question your expenses a lot more closely. So the best way is you keep your receipts, you have good bank statements, and you use a bookkeeper. Now, if you have a very basic business, sometimes you don't have a lot of expenses. Sometimes you're fine just to go with that. But if you're using a bookkeeper, you have to make sure they're doing this right. So you have to follow up with them, make sure you can't just put it in someone's hands and say, okay, you've got it, I don't have to worry about it. You still have to follow up, make sure things are done correctly, because I can't tell you how many times people got a bookkeeper that was doing a great job and then something happened in their life, or they fell off, or they got too busy, and then someone's bookkeeping got neglected. We've got to stay on top of it, and bookkeepers are known to be overwhelmed and very busy, but again, you have to make sure they're doing their job as well. Even though you hire professionals, still need to keep up with them, because who's ultimately responsible for your taxes? The business owner. If the bookkeeper messes up and you have a big tax bill, you might be able to reduce some of the interest and penalties, but you can't get rid of a lot of times you can't. And my bookkeeper messed it up, my tax preparer messed it up isn't a good excuse, because you're supposed to review and have an idea of what's going on with your business. So you should know what kind of taxes you're facing going in. So talking to a bookkeeper, ideally a CPA or tax preparer. Estimated tax payments. So if you have income, this is bigger than ever, because now the IRS is hitting people for an 8% penalty throughout the year if you don't make estimated tax payments. So if you're at a loss and you're losing money, you don't need to make estimated tax payments. But if you have any net profit, you have to make those, or you're going to get hit with a nice big penalty at the end of the year. And 24 is the first year that's going to happen. So it's going to surprise a lot of people. And how do you know if you need to make estimated tax payments if you don't have good bookkeeping, if you can't pull up a profit and loss? You can also use QuickBooks or Intuit. There's other programs where you can manage your income and expenses for a business, and some of them will pull it directly from your bank account if you pay for that service. But it has to be done correct, and you should be pulling a profit and loss every quarter, making estimated tax payments. The next payment is due June 15th, coming up in less than a month. So it should be based on net profit and go from there. So I love this first one. Know your limitations and know when you need to ask for professional help. When should you ask for help? When you're already in trouble or when you're not sure? I had someone actually call me that watched this show yesterday, and they had some questions. It wasn't something I could help them with. It was under $10,000. It was a smaller case, but I referred them to 2 tax professionals that could prepare us to returns, and I'm going to follow up with them and make sure everything's done correctly. But if you have questions, build a good team around you to support your business. Doesn't mean you have to have people on retainer. You shouldn't be paying people on retainer. But get a good CPA that you can, or tax preparer that you can ask questions. You can always call us as a tax attorney or law office and get good questions and get your questions answered. And especially when it comes to business, trust me, we've all been there where we're learning and you don't know what you don't know. So check in with other people, make sure you're doing it right, and follow that good advice when you get it. Keep adequate records. Again, I've been hammering in on this. So important. Separate your personal and business finances. So again, the audit, they're losing $20,000. Happens all the time. Legitimate business expenses that people don't get credit for because they are mixing personal and business. I have a much larger case, millions of dollars, where the owner is getting audited for multiple years. It's a huge audit, and this is her biggest problem, mixing personal and business finances. So again, large and small, it is one of the worst things you can do. Correctly classify your business, either as a S Corp or as a C Corp or as a partnership. So having that set up correctly and not playing funny games with your EIN is huge. Managing payroll. Again, you have to verify, 1, that they're doing it correctly, 2, that they're making the payments and filing the returns with the IRS. Don't just trust them. Trust but verify. I can't tell you how many businesses have ended up in huge, hundreds of thousands of dollars in debt due to their payroll company messing up. And sometimes life happens. One thing, someone clicked off a button or something like that, and it led to a huge case. They had to pay me to manage, a few $100,000 debt. They had to disclose their personal information and all their business information to the IRS. A lot of stress, a lot of headache. Making sure, like I said, don't trust but verify with everything you're doing with the IRS. And this is actually, subscribes to e-news for small businesses. There are, locally here in Tucson and elsewhere, there are free classes that you can go and talk to business coaches. If you've never even talked to a business coach and you're running a small business, you should consider it. Now, there's going to be some better than others, but going to Chamber of Commerce's, talking to other people about the challenges facing your business, how do I do this? You can get a lot of great information by getting connected to the small business community, and they're there to help out. So small business tax deductions, talk to your tax preparer, CPA. Just because you read a news article doesn't mean you qualify for it. There is a self-employment tax deduction. So that any tax preparer should know how to do that. If you run a small business of any kind of complexity, you should at least run it by a taxpayer. Making your tax payments timely. Again, very, very key to pay timely and file timely. So, again, I'm just going to lump these all together. We're running out of time. I've talked about a lot of this, but these are kind of things that you really need to touch on and make sure that you're on top of. Again, a lot of different resources here. And again, here's the taxpayer roadmap. I would absolutely, and And I love it when people just call in and say, hey, I have a question. And people tell me all the time, I want to be mindful of your time. You're an attorney. Your time's valuable. If I have free time, though, and I come home, my wife's going to have me in the yard or doing dishes, which isn't a bad thing. But I'm saying, I come home and it's very different. But call. Ask questions. I would much rather spend 5 minutes giving someone good advice than 5 years down the road they become my client because they have the huge nasty tax issue that could have been avoided. So look things up. We've provided a ton of information through this show. Look at other shows. Go to irs.gov. Educate yourselves, and when you're not sure, call and ask. You'd be surprised how easy I can help people just by answering some questions. I had someone the other day. They were on an installment agreement. They had most of the things taken care of. It wasn't much I could do for them. But they were paying they weren't. They were paying all kinds of taxes, trying to get rid of the tax debt. Didn't feel like they were making any headway, but they were paying off their oldest returns first. Said, you gotta flip it around, pay the current year first, and once you're caught up on the current year, then pay the next newest year and move backwards like that, because the oldest years eventually will expire. And there's multiple reasons, but again, it saves them hundreds of thousands of dollars over time by doing it right. So stay tuned and call us if you have any questions, 520-485-7371.